I wasted everyone's money, I wasted everyone's everything, and I feel bad. You don't think I feel bad?
Feeling bad doesn't absolve you from guilt. Right? Feeling bad doesn't restore the client back to where they were, financially before you screwed up their life and screwed up their life insurance need with a poorly designed, non-back-tested premium financing analysis. Hey guys, Darren Sugiyama here, president and founder of Lionsmark Capital, the most transparent premium financing intermediary in the life insurance industry. So in today's webinar, I'm going to address the two biggest concerns people are having right now with premium financing, and that is the borrowing interest rates as well as this recession that appears that we're headed into right now. So as we sit here in March of 2023, the prime rate is currently 7.75%, whereas last year in the summer of 2022, it was about 300 basis points lower. In addition to that, the one-year CMT rate is currently 4.90% at the time of this recording, March 14th, 2023, whereas last summer it was hovering in the low threes, high twos. In addition, we're coming off an S&P return of negative 22% last year in 2022, and there are speculations of the stock market not bouncing back this year in 2023. So the question is, how does all this affect premium financing? It's a great question. I'll tell you that the industry is seeing a massive slowdown in premium financing as a whole, but I've got to tell you, at Lionsmark Capital, we aren't seeing that at all. Business is actually up. So the question is, why is that? Well, the answer is pretty straightforward. You see, for the last 10 years, I've been modeling volatility in our backtesting software and using data analytics to evaluate different types of IUL products, as well as different loan models, and evaluating the historical relationship between premium financing loan rates and index performance. So the reports that our proprietary software generates is really the only way to know whether or not a premium financing model is going to be able to withstand the stress of short-term high borrowing rates coupled with short-term negative S&P returns and 0% index returns in an IUL. So without further ado, let's go ahead and get into this webinar where I'll discuss the historical symbiotic relationship between borrowing interest rates and index crediting rates. So we say the proxy is a fictitious hypothetical investment that behaves very similar to certain real-world products, in this case, the IUL. So if I go back about a decade or so, I went around to all the carriers and talked to all of their compliance departments, all their advanced markets attorneys, all their actuaries, and said, look, what I want to do is I want to build a model that's more educationally based for clients, where we can explain to them how floors and caps work, how volatility can affect final outcomes. We want to show them how the charges are structured and how the charges work. And they said, well, you can't rebuild a life insurance illustration, right? That would be non-compliant. But you could build this proxy model that you're talking about as long as you had the right disclosures. So that's essentially what we did. This proxy basically is built so that it behaves very similar to the IUL as it pertains to the contributions that go in would be the same as the premium schedule. The beginning of year charges are the same as the premium load charges. The monthly charges are the same as the remaining policy charges. The end of year credit would be the same as whatever the product's floor and cap would allow. We even built in there a participating loan option where we can model the depiction using the same participating loan rate as the product that we're evaluating. And then we backtest this. We use historical S&P 500 returns during 121 different historical 40-year periods, which I know seems like overkill, but we really wanted to be able to explain to the client, these are all the different outcomes that in theory could have existed based on the design of this product with all the volatility. And then lastly, we also can show historical borrowing interest rates. Now, this is extremely important when it comes to premium financing because all of the firms out there that were selling premium financing solely based on low borrowing interest rates were really doing the client a disservice.
you don't do premium financing because borrowing rates are low. You do premium financing because you understand over time the spread or the arbitrage between the borrowing rates and the crediting rates. Well, when we go back and show historical returns and historical interest rates, in some years there was a positive arbitrage between the two, and in some years there was a negative arbitrage. What our backtesting software does, it can actually show with a client how that relationship works and how it has worked over time. So our model, again, we model 121 different 40-year periods. And then we tagged the 40-year period that produced the best compounded annual growth rate out of those 121 different periods. And we also tag the period that produced the worst compounded annual growth rate. I always like to focus on the one that produced the worst compounded annual growth rate, just to be conservative. And I would always rather underpromise and then overdeliver. So in our model, we actually can extrapolate the charges and then model what the credits would have been in each one of those back-tested periods. So here's an example of what I mean by this. We have these charges and credits pages in our proposals. I know it's a lot of information here, but we can show them in this scenario here. Again, this is the 40-year period that produced the worst compound annual growth rate. This started right in fourth quarter of 1971. And what we'll do is break it down for them. So let's say in 1982, the S&P return was just over 37%. Based on a 0% floor and 10% cap model, the index credit in that year would have been 10%. So in this particular design, with this particular crediting method, in that year, they would have gotten a $1.6 million credit. There were $42,000 and change worth of charges in that year. So the cash value gain in that year would have been just over $1.5 million. However, let's say in 1989, the S&P took a negative 12% hit, which means the policy would have credited zero. So in that year, there would have been $0 credited based on the index credit. There was a $58,000 charge in that year, so your cash value would have decreased by $58,000 in that given year. If we're using a product with, say, a multiplier bonus, in addition to the cap, you would take that 10% return multiplied by 1.96. That is the multiplier bonus. And so the effective index credit in that year would have been 19.6%. And the cash value gain in that year would have been $721,000. However, in a year where you had a negative return and you would have gotten a zero, well, 0 times 1.6 is still 0. They would have, however, incurred the multiplier bonus costs, which are pretty expensive. So in that year, the cash value would have decreased by $466,000. So we want to be able to show the client how this process works. And a lot of agents at first glance will say, Darren, this is too much information. My client does not want to know the details. Let me tell you something. This client's buying a $30 million life insurance policy, and it's going to have interest payments in the 7 figures. They're going to want to know how the charges and credits work. And even if you don't think they do, years into it, if the client has questions or things just don't go as well as hoped and the client becomes litigious, you want to have something in the client file that proves that you talked about interest rate volatility, that you talked about how a floor and a cap works, that you talked about how charges work. And so that's part of what my firm does as a service when you do joint work with us in premium financing, is not only will we have all these reports in the client file, we also produce a 30 to 40 minute custom video where it's my voiceover going over the client's custom proposal. We then upload that video to the cloud. We then circulate the link to that video so that the client can rewatch the articulation of how all of this works. They can pause it, they can rewind it, they can watch it a gazillion times if they want. They can send that link to their spouse. So their spouse hears me explaining it as opposed to the prospective insured explaining it. They can circulate that link to their attorney or their CPA or their idiot brother-in-law or whoever it is that wants to understand what's going on here. At least they're hearing a compliant, accurate articulation of how this actually works. We can even get into participating loans and how those work. So we show them here. In the 11th year, we're showing the bank payoff. We're showing the cost recovery drawdowns. And we have the ability to show the policy loan interest that's being accrued. right next to the cash value gain that they're getting by leaving that money in the index account. What's really interesting here is over time here, over a 40-year period, the positive arbitrage between the participating loan amount and the index credit amount is over $31 million to the positive. And again, this was during the 40-year period that produced the worst compounded annual growth rate. I know this is a lot of data, it might even be overwhelming, but I just wanted you to see that the due diligence has been done and is well documented in the client file. This is a great depiction here. So the dashed green line here is the simulated account value during the best 40-year period. The dotted green line is during the worst 40-year period. The blue line is the actual as illustrated cash surrender value in the carrier illustration. I think this is really encouraging because it really speaks to just how conservative that carrier illustration is, given the fact that the simulated cash value during the worst 40-year period out of 121 different periods we analyze is substantially greater than the as illustrated numbers in the carrier illustration. In addition to that, the black line is the as illustrated death benefit in the carrier illustration. So I find this really interesting because in a real world scenario, if the real world product had a cash value that looked similar to any of those green lines, if the green line eclipses the black line, the death benefit cannot be less than the cash value. It would automatically push the death benefit north of whatever the cash value actually was in a real world scenario. So very encouraging. Great way to stress test the product as well as the design. Now the solid green line here, this to me is one of the most important things to look at, especially in the environment that we're in right now. This is a synthetically constructed 40-year period. The first 20 some odd years start out between the years 2000 and 2021. And then after that, we're showing a static return of 5.4%. Why is this so important? The reason is that some folks are looking at life insurance in general and saying, hey, I think we're headed into a recession. I'm a little worried. Maybe this is not the right time to do it. In addition to that, they're saying interest rates are also high right now. Right? So I'm paying a lot of interest, but not getting a lot of credit in the policy. Right? Well, that's what they think, which is why, again, historicals don't lie. So here again, we have the years 2000 through 2021. We have in column 12 there, the actual historical S&P returns. In column 13, we have applied the 0% floor and the 10% cap. Okay, after that period, then we're just doing a level 5.4% return. So if we blow that first 10 years up there, this is how bad it is, right? We got 1, 2, 3, 4, 5 negative S&P returns in the first 10 years of the sequence, in which case the policy would have credited 0, 5 out of the first 10 years, and even more specifically, 3 0% return years in the first 3 years back to back to back of the sequence. That's pretty adverse. But if we look at historical borrowing rates during that time, at least with one of our lenders, it tells a very interesting story here because in the year 2000, the borrowing rate is higher than the borrowing rates are today. But what happens, again, historically speaking, is as soon as there is a crash, there's a 2-year lag where the borrowing interest rate comes down, again, historically speaking, 2 years after a correction. So the borrowing rate went from almost 8% down to 4% and change, decreased down into the 3%. And then when we came out of that dot-com bubble, market had a 32% return, and now we see borrowing interest rates starting to rise again. Then again, we have the mortgage crisis, 2007, and then 2 years later, the borrowing rate gets chopped in half again. So it's really understanding the interrelationship between borrowing rates and crediting rates over time. This is the indisputable mathematical data that we have found is so important to show a client, because if you just hypothesize about these concepts, that doesn't give anyone any sort of real confidence. When you can show them indisputable math, That is really what pushes them over the edge in terms of really understanding what the real truth is in terms of the relationship between borrowing interest rates and crediting rates. Again, we go back to that solid green line. That tells a very, very valuable story. And then the last objection we might get here is that, well, I can get better returns in the market. We don't think that the life insurance death benefit IRR is going to be as good as if we invest it in the market. Well, okay, math doesn't care about your feelings. Math only tells you the truth, and historical math is indisputable. So on the left-hand side of the screen there, the green dashed line there, that is the greater of the as illustrated death benefit and the simulated cash value during the best 40-year period of the 121 periods we analyze. The blue line is the same contributions going into that non-insurance-based investment account after taxes, after fees. On the right-hand side, same depiction there. That is during the worst 40-year period out of the 121 different periods that we analyzed. So again, if they're doing this purely for death benefit purposes, pretty hard to argue when you look at the numbers there.
So during the early 80s, interest rates were extremely high, relatively speaking. One of our lenders uses a prime-based loan rate, and their loan rate calculation is prime minus 1.6%. Well, at the end of 1982, prime was 11%. So 11% minus the spread of 1.6% would equal a borrowing rate in 1982 of 9.4%. Now, imagine if premium financing borrowing rates were 9.4% today. That, quite frankly, I think would freak most people out. That seems incredibly high relative to today. But I was also curious as to what historical S&P returns were like during the same period of time, 1982 through 1993. So here we have the same backtested historical period, 1982 through 1993. In column 12 there, we have the historical S&P returns during that period. And assuming this particular carrier's floor and cap, and again, we're reducing the 10.5% cap down to 10%, just to be conservative. And then we're also factoring in the multiplier factor. So column 14, the orange column, represents the effective index credits in each one of those years based on that particular floor, cap, and multiplier design. So the real question is, how do these historical returns match up with the historical borrowing rates? Because if all you're looking at is interest rates, you're really oversimplifying the real issue here. The real issue is not what the interest rates are solely. The real issue is what is the ongoing symbiotic relationship between the historical borrowing interest rates and the historical index credits. So if we look at the symbiotic relationship over time, historically speaking, the reality is, in this particular depiction here, that starts with a very high interest rate environment, there were only 2 negative S&P returns during this 12-year period, which would have meant there would only be 2 0% index credit years during this 12-year period. And again, history tells us that the correlation between interest rates and S&P performance are very, very closely related. So if we look at the total 40-year period here, I also wanted to be overly conservative and take the multiplier benefit out of the equation completely and just look at the comparison between the index credit and the borrowing rate using a 0% floor and a 10% cap. The borrowing rates here, we're using 40-year historicals using a prime-based loan, again, prime minus 1.6. And in the green cells there, we see years wherein there was a positive arbitrage between the index credit and the borrowing rate. And in the red cells there, we see years wherein there was a negative arbitrage. But if you look at the top, in the first 5 years where the borrowing rate was north of 9%, in 3 of those 5 first years, there was still a positive arbitrage based on S&P performance. So even though we started off with a sequence during a very high interest rate environment, over this 40-year period, there was actually a 2.1% average positive arbitrage between the historical index credits and the historical borrowing rates. And it doesn't stop there, because the other question is, how does this affect the total financial outcome over time? Now, this is assuming a 10% cap. What if caps drop even lower than 10%? Okay, well, here I'm going to model a 7% cap. And so using the same backtested period with a 0% floor and a 7% cap, we still eke out a 14 basis point average positive arbitrage. But the reality is, historically speaking, caps have been higher during high interest rate environments, right? And this model assumes a static 7% cap even during times where those interest rates are higher. Now, to give you an example, let's roll the clock back 7, 8, 9 years ago. What were caps 7, 8, 9 years ago? If the average cap today is hovering between 8 to 10%, 7, 8, 9 years ago, average caps were hovering right around 14%. So historically speaking, not only has S&P performance been greater during higher interest rate environments, IUL caps have also historically been higher. Yet in this depiction here, I'm assuming a static 7% cap even during times where the historical borrowing rate would have been 9.4%. And then on top of that, one of the most important things to understand when it comes to premium financing is that negative percentage arbitrage does not necessarily mean a negative dollar arbitrage. What I mean by that is, let's say, for example, the borrowing rate was a hypothetical 5%. And let's say the index credit was also the same hypothetical 5%. Well, you would say, oh, well, we broke even in that year. Well, not necessarily, because as time goes on, the 5% borrowing rate is charged to the cumulative loan balance. Now, assuming you're not accruing interest, that cumulative loan balance, you're paying simple interest on that cumulative loan balance. However, if you're crediting 5% in the policy, you're crediting 5% on the accumulated value of the policy, which is a compounding number each year. So if you're being charged 5% on a lower dollar value, which would be the cumulative loan balance, but you're crediting the same 5% on a higher dollar value of accumulated value in the policy, though you might be breaking even in terms of a 5% interest rate and a 5% crediting rate percentage-wise, from a dollar perspective, a 5% index credit on a higher accumulated value would credit a higher dollar value to the policy value than the dollar value of interest that you're paying on the premium financed loan. Okay, and if you're wondering if you can finance whole life, the answer is certainly yes. But a lot of folks will say, well, whole life dividend credits right now might not be enough to get a positive arbitrage when it comes to premium financing. Well, what I did was I looked at the same look back period, 1982 through 2021. And in that red box right there, those are the historical dividend credits from 4 different whole life companies: Guardian, Mass Mutual, Northwestern Mutual, and Penn Mutual. Just next to those historical dividend credits in the green column there, those are the lowest performing dividends of each of those 4 carriers in each one of those back-tested 40 years. Now, if we compare the lowest performing dividend of those 4 carriers to the historical borrowing rates, assuming prime minus 1.6, we see that in that 40-year period, there were only 4 years that experienced a negative arbitrage. The lowest performing dividend credit out of each of those 4 carriers was greater than the historical borrowing rate in 36 of the 40 years. If we look at the graph on the right-hand side of the screen there, again, the blue line is the historical prime-based loan rates, and the green line is the lowest performing dividend of those 4 carriers in each one of those years. Historically speaking, the symbiotic relationship between the borrowing rate and the whole life dividend credits actually eked out a 2.14% average positive arbitrage. So when it comes to premium financing, one of the most valuable elements that Landsmark Capital brings to the table is the ability to show you historical data that tells a more accurate story of how premium financing actually works, how all the moving parts work, and how by stress testing the design through our proxy and our software, we can analyze this range of potential outcomes, which allows us, in my opinion, to present a much deeper understanding of how the different elements of premium financing actually work in reality. In this version of premium financing, you'd pay a level annual contribution, which we see here by yellow arrow at number 1. And these contributions are paying 100% of the reduced premium in years 1 and 2, and a portion of the premiums in years 3 through 10. And in the column under yellow arrow number 2, we see the lender starts funding additional premiums starting in year 3. And they continue to fund these additional premiums in years 3 through 10. Now, the interest due on that borrowed premium in the red box by yellow arrow number 3 is not paid by you. It's going to be accrued. And what that means is that because you're paying in some of the premiums along the way, the lender allows you to not pay the interest due on the loan balance. And they allow you to roll that amount back into the principal loan balance. This is called interest accrual. And the reason they allow you to do this is that because you put some skin in the game in the form of paying the first 2 years premium yourself, kind of like buying a home using a mortgage loan, but making a good-sized down payment in the first 2 years, and then paying some of the principal each year and only mortgaging a portion of the remaining amount and accruing the interest. We have the borrowing interest rate resetting, assuming a rate increase each year, but in reality, the newly reset rate could be higher or it could be lower than what we're showing here. This is just a hypothetical depiction, assuming that borrowing rates increase every year into perpetuity, which may or may not happen. Okay, if you jump over to yellow arrow number 4, that shows the estimated outside collateral required. Now, there would never be any collateral you'd have to post in years 1 or 2 because the lender capital doesn't enter the picture until policy year 3. Now, it is possible that you'd have to post some outside collateral after the first 2 years if the policy cash surrender value is less than the loan balance. In the bottom box there, it shows you the type of collateral assumption we're using in this particular depiction. But in theory, you could also use a CD or a letter of credit or a marketable securities account. And in some cases, you could even use real estate equity as collateral. And then yellow arrow number 5 is showing the policy value paying off the third-party lender in year 11. And yellow arrow number 6 shows the tax-free income drawdowns that you could receive based on certain assumptions regarding certain performance of the interest-bearing account inside your policy. So when it comes to premium financing, we always want to show the logical alternative. And the logical alternative is to just buy a basic non-finance life insurance policy. So let's take a look at this comparison. Okay, so yellow arrow number 1 shows the annual premiums that you would have to pay in a non-finance policy. And yellow arrow number 2 shows the income drawdowns that you could get by paying that annual premium based on these particular assumptions of index performance. Yellow arrow number 3 shows you the partial premium payments that you would pay in the premium financing design that we just looked at on the previous slide. And yellow arrow number 4 shows the income drawdowns in that premium finance design. So over the course of time, yellow arrow number 5 shows you the difference in total income drawdowns between the non-finance policy versus the financed one. And yellow arrow number 6 shows you the total economic benefit of both designs, which is the total income drawn down plus the remaining cash value at the end of the 40th year. And if you look at the graph on the right-hand side of the screen, the green bars represent the net death benefit in the premium financed arrangement, and the orange bars represent the death benefit in the non-financed version. So this is why this backtesting report is so valuable. We showcase this synthetic proxy depiction during the best and worst 40-year periods analyzed, with all the charges deducted and the credits with any bonuses that may exist. And we compare it to a depiction using the static return assumption shown in the carrier illustration. So the data in this graph shows the simulated account values of our proxy during the period that produced the best compound annual growth rate out of the 121 different historical periods analyzed, right there in the heavily dashed green line. It also shows the simulated account values of our proxy during the period that produced the worst compound annual growth rate out of those 121 different historical periods analyzed in the dotted green line there, versus the account values assuming a static return as depicted in the carrier illustration right there in the blue line. Now, what's also interesting to point out is that the black line there uses the same data as depicted in the carrier's illustration's death benefit, based on that static return assumption that we see there at the bottom of the page. Now, if the actual cash values in a real world life insurance policy were equal to these green dashed or dotted lines, and they eclipsed the black line in this graph, the actual death benefit would automatically be pushed up, because in a real world life insurance policy, the death benefit must always be higher than the cash value at any given time. And it's important to note that both the outcomes in the hypothetical synthetic proxies and the numbers in the carrier illustration, are all hypothetical depictions. Right? I mean, no one knows what the future performance of the market is going to look like, so none of these hypothetical depictions are guaranteed. But the spirit of what we're showing you here is rooted in transparency and in really client education, so you can better understand the crediting method and assumptions made that produce this range of hypothetical outcomes. Again, this video is purely for educational purposes to briefly explain these hypothetical models. And lastly, for those people that are concerned about us heading into recession, the solid green line depicts the simulated account values in our proxy, assuming the S&P 500 performance from the years 2000 through 2021 during the first 22 years, and then a static average return thereafter in years 23 through 40. Now, during this time, there would have been 5 0% index credits within the first 10 years of this sequence. And even more importantly, this sequence starts off with 3 0% returns in the first 3 years. Now, we also tracked borrowing rates during the same backtested period, and we see at the bottom of the screen the total interest paid out of pocket during this time was actually less than what current borrowing rates are depicted at in the first 3 scenarios, because historically speaking, interest rates were lower during that period of time than they are today, despite them being on the high end in the year 2000. And so that's why it's important to understand that in premium financing, we have to analyze the historical borrowing rates compared to the historical crediting rates, to truly understand the relationship between the two. So it's not just the borrowing rate or just the crediting rate assumption that we need to look at. And in this back-tested scenario that starts off with arguably the worst 10-year sequence in the modern economy, we see that premium financing using this particular model works extremely well from a mathematical standpoint. This summary page shows 2 different types of hypothetical assets. Now, our backtesting platform literally analyzes 121 different actual historical 40-year periods, and we tag the 40-year period that produced the best compound annual growth rate, as well as the 40-year period that produced the worst compounded annual growth rate. In the top section, the bar graphs show the total retirement income drawdown. The line graphs in the bottom sections show the ongoing account balances. Now, on the left side of the screen shows the outcomes during the best 40-year period that we analyzed, and on the right side of the screen shows the worst 40-year period that we analyzed. The green represents the financed options, and the blue line represents the non-financed traditional investment. So we do this analysis with every single premium financing arrangement we design. And as you saw in today's webinar, the value of being able to backtest and stress test is really the only way to truly evaluate the efficacy of a premium financing arrangement. And for all the people out there that say, oh, Darren, you're being overly analytical, I highly encourage you to watch the webinar on our website about the huge premium financing lawsuit that both Forbes and the Wall Street Journal reported on, where I do a deep dive into the plaintiff's accusations against both the advisor and the carrier. And I explain how our more transparent and more responsible method of premium financing would have avoided a lawsuit of this kind. Again, you can go to our website, lionsmarkcapital.com. Go ahead and click on Webinar Library. You can scroll down and you'll see that recorded webinar that you have access to. And again, for those people that say that I'm taking this too seriously, I just have one thing to say. And that is, yes, I do take this extremely seriously because I know just how much damage the wrong premium financing arrangement can inflict on a client. And for those advisors that still refuse to transparently show a client the back-tested analytics that Lionsmark Capital advocates for, I'm telling you, they're going to end up crying and apologizing when their client sues them, and they're going to claim that they didn't know the risks and that somehow it's not their fault. So they feel bad, but feeling bad doesn't absolve you from guilt. Right? Feeling bad doesn't restore the client back to where they were, financially before you screwed up their life and screwed up their life insurance need with a poorly designed, non-back-tested premium financing analysis. Lionsmark Capital is the only premium financing intermediary that has the software to do this analysis. And though I try to make these webinars entertaining and engaging, injecting some humor and into the content, please do not mistake my sense of humor for being cavalier about these clients' misfortune of working with the wrong premium financing intermediary with the wrong premium financing design. It's terrible what some of these clients of other firms have experienced. But the point I'm really attempting to drive home with you is that if you truly want the proper due diligence done on your premium financing cases, then work with me and Lionsmark Capital. We'll make sure that the proper due diligence is done, protecting your clients from harm's way. You'll be glad you did, believe me. So, I hope you enjoyed today's webinar, and I look forward to seeing you soon. Have a great day.